Chapter 6, Part 2. Let's start with the various inventory systems. So we've talked about weighted average. Now we're coming into first in, first out. And I have a cheat note here that might help you put in perspective what is going on. And I would suggest using this cheat note, especially for your tests and also your homework. And what we have here is I've drawn a bucket. Excuse my artwork, I'm not Michelangelo, but I think it'll still help you visualize what's going on. So you have a bucket, and as you buy your inventory, it gets filled up. Well, FIFO says the first in is first out. You're pulling from the bottom of the bucket. Whereas in LIFO, you're pulling from the top, i.e. your last purchases is the first out. And so this can affect your cost of goods sold, as well as your ending inventory balance. And so let's give an example here. Let's say you make 2 or 3 purchases. So you fill up some inventory, and then I would go ahead and write in here, maybe you bought it on August 3rd, and you bought 100 units at, let's say, $2.30. Write it in. And then the next day, or next purchase point, maybe you go ahead and buy some more inventory. Fill it up. Just keep filling up your bucket here. So let me just put another one in there. Maybe you bought it to August 12th. You bought 230 units. That maybe 240, and then maybe you bought a third for that month. Put it in, and I would definitely label everything here: the date, the units, and the price that you bought. So let's say we bought this at the 24th, and maybe you bought 240 units at, let's go 2.45. Now you have your buckets being filled up by inventory, and again, depending on the method you're using, FIFO if you're pulling from the bottom, or LIFO. So if the problem is, if you sold, let's say 300 units, what is the value of your ending inventory, or what is your cost of goods? So you know, if it's FIFO method, that you sold the 300, all 100 units here and 200 here at this price. And so you could calculate it, and your ending inventory is left. So you had altogether here, 570 units, you sold 300, that means you have 270 units left. Well, if it's remaining from the top, 240 of those units were at 245, and the remaining 30 units was at 240. And so this will help you visualize calculating the different methods, because what's going to happen in your homework and your tests is I'm going to give you so many units in your beginning inventory. You bought at certain points of time and during the period, and then you sold so many units at that period. And what was the cost of goods sold, and what is your ending inventory? Those are going to be some of your test questions coming up. This will help you visualize and to calculate. Don't just try to do it from your head, at least not in the beginning. This will help you visualize the process of what's going through. So let's go ahead and now continue back over here. So the first in, first out, again, you're pulling from the bottom, and your ending inventory is what was at the top of the bucket. We're going to 17. First in, first out, again. You're going to calculate, and you have to calculate when your goods were purchased, the various dates, again, the number of units, the purchase price, and then how many of those units did you sell. And this is going to be true of every inventory method. You're going to have to get quite detailed on when, how much, how many units, and at what price to calculate these from. 18, I'm just going to go through some examples. And so let's talk about a journal entry that you have to be aware of when dealing with inventory. So you make your variety of purchases, and again, you're just purchasing inventory. and you're doing it on accounts payable, pretty standard. However, when you make a sale, notice that there's two entries per single sale. So what's happening is you make your sale and you record it, so they're selling it on accounts receivable, and you make a sale, but now you've got to calculate this cost of good inventory. And so and you're deleting from your inventory. And this has to be calculated based on whatever method, whether you're using the weighted average, LIFO, FIFO, or specific identification. And this is going to be part of that calculation that can hurt you on your test questions. And so you remember, you're recording the sale, and then you're recording the cost of goods sold and the depletion of your inventory. Again, last in, first out, same concept as FIFO, only now you're selling from the top of the bucket versus the bottom of the bucket. And let me give you a picture of this. So here's your LIFO. Now you're making your sales from the top versus from the bottom. And again, it's going to change your pricing here by what units are you selling here versus your remaining balance. And so you have to keep track of that, and I think that visualization will help you immensely. Let's get to the next slide. Again, they're just going to go through some examples and how that will affect the pricing. So a test question that I'm going to have is, I'm going to give you a set of examples of, dates purchased. Here's your beginning balance, a variety of purchases, and then I'm going to ask you the weighted average, LIFO, and FIFO. What are the different costs of goods sold, and what is your different ending inventory balance? And you're going to have to calculate those for the three methods. Again, last in, first out, it doesn't change. You still have to calculate your cost of goods sold here. And notice this amount is different from the previous amount. Again, your inventory method is going to change the cost of your goods sold as well as your ending inventory calculation. Weighted average is a different animal here a little bit. So here what's happening with the bucket is that every time we make a purchase, i.e. make a purchase here, there's nothing to calculate because we know all units are at 239 here at the first. But when we purchase again, you have to recalculate, and you only recalculate every time you make a new purchase. You do not have to recalculate when you make a sale. So on August 12th, you're going to count up how many units remain in your bucket from the August 3rd purchase, how many remain, and then the units here calculated, and then you're going to add those units and blend the price. So it's going to be, let's say there was 80 units left in August 3rd, it would be 80 at 239, you get a full amount, 230 at 240, add those two prices, add those units, and redivide. And so you're going to have to do this every time you make a new purchase for the weighted average. And again, they're just going to go through an explanation on a calculated basis here in the next couple slides. I think you can follow that rather than me verbalizing it. Again, the amounts are going to be changing here depending on each method used. And again, you still have to journal the sales, your cost of goods sold, and your merchandise inventory. And as you can see, these numbers are changing based on the different method that you're utilizing here. Financial statements of the effects of the costing method. Because prices change, your inventory methods nearly always assign different cost amounts, both to your cost of goods sold as your ending inventory. And here they give you an example. They show you the specific identification, FIFO, LIFO, weighted average, and it comes up with different numbers for your cost of goods sold. And then it will change your net income, and it changes your ending inventory. So it's going to affect both your income statement as well as your balance sheet, depending on which method you use. And you've got to be able to calculate all four methods for the test, as well as in practice, because this is used extensively all the time, as a matter of fact, by businesses. Okay, there are some advantages. Why do one company choose one method versus another? Some advantages of the different methods. The weighted average tends to smooth out price changes. Maybe the companies don't want to deal with it and they just want a more of a consistent pricing model. Here in the first in, first out, your ending inventory approximates its current replacement cost. And LIFO better matches the current cost and the cost of goods sold with revenues. But I'll be honest with you, I find the biggest reason people choose it for is actually for the tax reason. We'll get into, well, I guess we're getting into it now, the tax effects of costing methods. The Internal Revenue Service identifies several acceptable inventory costing methods for reporting taxable income. And most, again, choose the FIFO or LIFO. If LIFO is used for tax purposes, the IRS requires it be used for financial statements. So this gets a little bit complex. While each business has the freedom to choose, there can be some issues depending on the method, such as in LIFO. If you use it for tax, you must use it for your financial statements, which is not true if you use FIFO. And again, they're getting to the consistency principle that you use the same method from period to period. Now you can change, but if you do change, you have to disclose that change, and then you have to show what that inventory effect would have been on the old method versus the new method, so investors and creditors can make a comparative difference. I'm going to be running out of time here, so let me stop at this slide and we'll finish with part 3.